You walk into a bank, sit down, and ask for a loan. They give it to you. Simple, right? You walk out with cash in hand, but where did that money actually come from? Not the bank vault, not someone else's savings. It's not as straightforward as you might think. This is the story of how money is created out of thin air and why you should care. When you borrow money, it feels like a simple exchange. You need cash, the bank provides it. But here's the thing, that money didn't exist before you asked for it. It's not being pulled from a safe somewhere. In fact, the very moment you sign that loan agreement, the bank creates the money. It's not magic, it's how our financial system works. And once you understand that, you'll start to see the cracks in the system. Here's how it works. Banks don't have piles of cash to lend out. Instead, they have the power to lend money than they actually hold. When you take out a loan, the bank doesn't physically hand over someone else's deposit. They simply credit your account with the loan amount. That's new money, created from nothing. This is called fractional reserve banking. It's been the foundation of modern economies for decades. In short, banks don't lend money they have. They lend money they don't have yet. Now, let's get to the uncomfortable part. That money you borrowed, where does it go next? As soon as the loan is approved, the bank has to hope you'll pay it back with interest. And here's where it gets risky. That loan is just one of many floating in the system. Banks don't hold on to the loan forever. They're incentivized to lend it out again and again, creating more money with every loan they approve. So where does this lead? More debt, more loans, and more money circulating that wasn't there before. This sounds good, right? It keeps economies moving until it doesn't. Here's the catch. The bank's money creation only works as long as borrowers can repay their debts. If enough people default, if a recession hits, everything starts to unravel. The money banks created vanishes into thin air, and that's where the true risk lies. Because as easy as it is to borrow, it's just as easy to go broke when the system breaks. And once the debt pile grows high enough, the whole system depends on constant growth, an endless cycle of borrowing, lending, and more debt. Now, you've probably heard that this system is designed to boost the economy, and it does, for a while. It keeps businesses running, consumers spending, and governments in control. But the truth is, it's built on an unsustainable foundation. The higher the debt, the more fragile the system becomes. And one day, something will tip the scale. A small shock, a sudden crisis, an event we don't see coming. The entire financial house of cards can collapse. Why does this matter? Because the system that seems so solid, one where money appears out of nowhere, depends on a global game of trust. As long as everyone believes the money is real, it is. The moment doubt creeps in, everything could fall apart. So, the next time you think about taking out a loan, ask yourself, where does the money really come from? And, more importantly, what happens when it doesn't come back? The truth is, no one really knows where the end game is. We're all just playing a game of chance with money that doesn't really exist until it does.